Hi, this is Lee DeLorenzo, the president of United Asset Strategies, and I'm joined today by Tom Healy. He is the director of client portfolio analysis, and as we've been doing, we're going to take a look back at 2019, where we are, where we've been, and where we think we're going. So first off, 2019 was a phenomenal year in the markets, whether you were in stocks or whether you were in bonds. And for instance, bonds, whether you were in treasuries or municipals, corporates, junk bonds, your rate of return was maybe from 4 to 15%. And stocks, as measured by the Standard & Poor's 500, the 500 largest companies in America, if you didn't reinvest dividends, you made about 28.9% on your money. And this is important because the year before we were down over 6%. So we also just finished a decade. So with these rates of return all over the place, let's look at the last 10 years. For the last 10 years, the average return, if you didn't reinvest dividends, was like 11.2%, which is a really good number. But what's important is, where did the number come from? Was that rate of return just a unreasonable exuberance, or did it come from important things like earnings? And when you look inside, we were able to find statistics that show that about 80% of the growth came from corporate earnings improving. And now, when you look today, as we enter the year 2020, we're at the same point in as much as we have elevated valuations, and we're very cautious and concerned about where are the earnings going to come from. So between those and the wall of worry that we talked about last quarter, I'm going to turn it over to Tom, and he's going to take us through what's really happened in the last quarter and where we stand now at the beginning of a new decade. Tom?
Thank you, Lee. In our quarterly, we give a progress report on the various risks and concerns that investors are grappling with over the past few quarters. We're calling the wall of worries. First, I'll start with those risks that we think have diminished over the last few quarters. The first is the trade war. Fear of a growing trade war began in 2018, continued into 2019, resulting in higher tariffs and the threats of further tariff increases. While there were fits and starts to the negotiating process, we're now closing in on a Phase 1 trade agreement between the U.S. and China set to be signed this week. There's also an agreement in place on a North American trade deal. So from the trade perspective, we think the risk has diminished. Next is the global recession risk. Starting in 2018, the data we track began to turn down, particularly on the manufacturing side, late in 2018, and continued its decline in 2019, sparking fears of a recession. More recently, however, the manufacturing data seems to be stabilizing both in the U.S. and in Europe, and as well as in China, and the service side of the U.S. economy remains fairly strong. We would highlight the consumer confidence data, which is helped by lower interest rates, the solid labor market, and an upswing in housing in recent weeks. Another issue that was facing investors is corporate earnings. Specifically, due to the tax cuts in 2018, there was fears of an earnings recession in 2019. Now we're in the first few weeks of our fourth quarter earnings, but it looks like 2019 earnings will be in the 2 to 3% range. Now, as we look to 2020, earnings are expected to grow more like mid-single digits. As we're not cycling those tough tax cuts, we're going to see a turnaround in earnings from the energy sector and margin improvement from some select large companies like Facebook and Google and Amazon, which had higher expenses in 2019. And as that diminishes, we'll see better earnings growth this year. And when you add the revenue growth in from the economy, we're looking at 5 to 6% type earnings growth. Another issue is global monetary policy. In 2018, the Federal Reserve raised rates, which pressured markets. And then in 2019, they began to cut, which was supportive of the economy and of equity markets. Now, while we expect the Fed and the ECB, the European Central Bank, to remain accommodative in 2020, we're closely watching to make sure they don't feel an end to that accommodation is warranted. Now, two specific issues where risk remains elevated are, one, the U.S. political arena. This week, in fact, Nancy Pelosi is expected to move the articles of impeachment to the Senate for a trial to determine whether the president will be impeached and removed from office. In the Senate, you need a supermajority, meaning 66 votes. Therefore, about 20 Republican senators have to vote in favor of impeachment for that to happen, a very high hurdle. More importantly, we're watching very closely the progress in the November election. Now, it's very early for predictions. In fact, we don't even have a clear frontrunner in the Democratic nomination process. But the good news is that markets tend to perform well in the year a sitting president is up for re-election, as both monetary and fiscal policy tend to be working in your favor. In fact, in December, the president signed into law a $1.4 trillion fiscal stimulus package for this year, known as the budget, that will continue to help the economy and be good for markets. So we're analyzing U.S. political developments in real time. And the last thing I'd mention, and I think the highest risk, is geopolitical. Most notably the risk in escalation and military aggression between the U.S. and Iran. This is a very fluid situation. Both sides say they don't want to go to war, but if anything progresses in this way in a negative manner, that will increase things like oil prices, will impact the economy, impact markets and volatility. So the bottom line is, as we see it, that there's a reduced level of risk relative to where we were a few quarters ago, and as a result, as Lee mentioned, we're cautiously optimistic on the markets.
Thank you very much. So one thing that we used to talk a lot about, because it was suddenly in the news and reality, was volatility. And volatility's been relatively low in the marketplace. So when it comes back, because it will it be tied to recessionary conditions? And at this point, we're comfortable that the recession is not imminent, and therefore any sell-off due to increased volatility, which just bring us back to normal levels, would not be a huge selling requirement, but rather perhaps a buying opportunity. So the markets weren't the only thing that were busy last year. Even Congress was able to pass an act in December called the Secure Act. And by its name, it's supposed to encourage us to save for retirement. And they targeted older ages, in as much as just a few bullet points would be that there was a prohibition on individuals that had reached age 70 and a half couldn't contribute to their IRA anymore. They removed that restriction, and now if you're working, you can contribute regardless of your age. The second thing that they did was to postpone the mandatory requirement from age 70 and a half to age 72. Doesn't mean you can't take your money out of your IRA, but you don't have to until age 72. And suppose the way that they have to pay for this is that they take it away on the inherited IRA. Typically, if an individual should pass away and they weren't married and they're leaving the money to their children, and the child is age 30, 40, or 50 years old, they were able to stretch those distributions out over the younger person's lifetime. Now we'll be forced to take the money within a 10-year period, which will add to taxes to the government very quickly, because it'll be over 10 years instead of perhaps 30, 40, even 50 years. So there are exceptions: minor children, disabilities, etc. So if you want to know more about that, just let us know, give us a call, email us, and we'll be happy to give you some planning ideas. Excuse me. I also want to touch on the fact that in the Secure Act, they have a provision to stimulate small businesses to set up 401k plans. One is a tax credit should you include automatic enrollment, so that when an employee becomes eligible, they're automatically put in the plan as opposed to making it optional. The second thing is that they're making it easier for small businesses to band together. It's called a multiple employer plan. And the premise is that when employers band together, there'll be more money and lower operating expenses. That's yet to be seen. We have experience with MEPs and MEPs. We're happy to answer your questions and offer opportunities as they become available. So 2019 was certainly a busy year. We're looking forward to an incredible 2020. Accolades here at United, we touched on them before, is that we reached $1 billion of assets under management. Very excited about that. And also I was included in the Hall of Fame at Barron's, and I thank them for that honor. 2020, I hope, is a terrific year for you, and that you're happy, healthy, and very peaceful to you and your family. Thank you.